Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I've got a really interesting episode for you today. I'm often asked the question about whether property can continue to grow at 7% per annum. Now, where do I get the 7% from? Well, it's the past growth really since 1980. The average growth rate in most capital city markets of the median house price is 7%. Now, remember, that's the median house price, which means it's all the sales and it's just the middle of all those sales in terms of what that value is done. So, of course, it's not the average. And obviously, the median hopes to strip out kind of outliers, which is important in property because some properties can sell for 50 million, 100 million, 200 million, whatever it might be. But it just means that more than 50% of those properties have actually grown at a faster rate than 7%. And the idea is that how can that continue to grow? Because obviously property becomes less and less affordable to more and more people, and can that growth continue? I was asked about this a couple of weeks ago on YouTube channel. So I get a lot of comments on YouTube, which is great. And I try and spend a bit of time over there answering all those comments. And I was asked about the question and I gave the response, but then I sort of sat back and thought about, well, we probably need to have a deeper dive on this. And I think it's a really important question to ask ourselves as investors. It's critical, in fact, because the answer will obviously inform you about your asset allocation, how much money you want to put into property. And then secondly, really invite you to think deeply about what type of property, what location, what attributes are you looking for in order to achieve that 7% benchmark? And remember, if property grows at 7.2%, the value of your asset doubles every 10 years, which was the question from the podcast listener. They asked me that at the moment, an inner city terrace home might cost $1 million in an investment grade location. How could that asset possibly be worth $8 million in 30 years? And the $8 million arises from it doubling 3 times, to 2 million after 10 years, to 4 million after 20 years, and obviously 8 million after 30 years. And obviously today I'm going to construct my answer to that question. So the first point I want to make is that human beings really struggle to grasp how numbers compound over long periods of time. Our brains are hardwired to think in linear terms, but compounding is really an exponential process. So, whereas our brains, evolved by making very quick decisions about a small number of objects, like whether it's some berries or, in terms of other animals, those sorts of things, but not really to process large or abstract numbers. And so that's the first thing, is it's very difficult to get a head around that. Secondly, when we're looking at these projected numbers, particularly over really long periods of time, like 20 and 30 years, it's often best to exclude inflation, because inflation can make it even more difficult to get your head around. Again, it's very easy to underestimate the long-term impact that inflation has on these numbers. So if we're thinking about how can that property be worth $8 million in 30 years, if we use an online calculator, I've got a link on the blog and the website to one of those, or a simple spreadsheet formula in Excel, we can work out that if the inflation rate averages at 2.5% over the next 30 years, that $8 million property is really $3.8 million in today's dollars. Now, that's a little bit more relatable, right? In real terms, excluding inflation, that property's worth 4 times more in 30 years. Now, we can take it one step further and say, well, forget about the inflation rate. Let's discount it back using household income growth rate, the average income growth rate in Australia, which is kind of the wage price index, typically sort of around 3 to 4% in terms of growth. That's what incomes do on average in Australia. And that is just really a proxy for general affordability. If we say, well, our capacity to be able to buy property is linked to our income as a general rule for most Australians. So let's think about in terms of affordability on that basis. So if we discount the 8 million, instead of at 2.5% inflation, we go 3% income growth, or you could even go 3.5%, then the present value of that asset drops to $3.3 million. So just a little bit more than tripling over that period of time. So in other words, For price appreciation to occur at this level, so for the property to be worth $8 million in 30 years' time, there needs to be enough potential buyers for this property that has their purchasing power grows at a much faster rate than 3% per annum so that they can afford to push that property price higher. And so but the question then becomes like, will that asset be worth $3 million? Like, can I see that people can pay 3 times more than the average growth rate over that period of time? So discounting those numbers, taking the inflation out, because obviously inflation has an impact. And when we look at the 7% growth, what we're really looking at is 4.5% real growth plus inflation. If we strip those numbers out, it starts to become more relatable, but it still is really difficult, right? Because if I look at that $1 million asset, it probably sold for $80,000 in the early 80s, right? And if I told you in the early 80s that this property in 2025 would be worth $1 million, that would be crazy, because in the early 80s, $1 million could probably buy you one of the best properties in Toorak at the time. And so that's why we find it really difficult to get our head around how these numbers sort of compound out over time. But that's not the whole story, really, because the property is certainly more affordable to more people in the 80s than it is today. So I'm not here saying that, look, nothing's really changed here. I think it has changed. I'm certain I've seen it, like in terms of the people, the demographic that can afford to buy property in blue chip investment grade locations has certainly changed over that period of time. But therein lies the hint, right? Because the top 20% of households earn half of all national income. So let's put some numbers around it. The ABS, back from the 22 financial year, top 20% of income earners, so the highest income quintile, received 47.8% of gross disposable income before tax and social assistance benefits. So it makes a pretty stark number, right, where all this income is going. And remember, income is only one of the attributes that is necessary to drive property prices higher. Now, when we have a look at the income growth, because we can look at the wage price index, but it's good for macroeconomic discussions, but not really for these sorts of discussions. So when we look at the different quintiles of income growth, the highest quintiles, so the top 20%, their growth rate was 40% higher than the second and third highest income quintiles. Now, interestingly, the lowest income quintile still had a similar growth rate, but that's just because welfare benefits and so forth have increased certainly quite a bit over the last just few years. But it's really what we're looking at is sort of the middle group versus the upper group. And the upper group has 40% higher income growth rates. And remember, the lowest income quintile, unfortunately, probably don't have a lot of property purchasing power, aren't going to be the demographics that are going into that area. Most people, when financially able, so putting aside financial ability and affordability and so forth, want to gravitate to locations that offer the greatest convenience, amenity, safety, and aesthetic appeal. So therefore, when we consider the question, can property continue to grow at 7% compounding per annum? We need to think about or define what property are we talking about. Are we talking about just generally of all property in Australia? No, likely not. In fact, if you look at the last 20 years, the average growth has been a lot lower than the previous 20-year period, which I've spoken about previously in this podcast. Now, I don't want to cherry pick time periods here because there have been specific issues that have gone on during those different sort of 20-year periods, if you like. But I think the point is that not all property can grow at 7%. I think that's something that we all need to, you don't have to agree with me on this, but we all need to contemplate. Can all property grow? No. The answer is no. So therefore, where is property going to grow? Well, property in locations that are very attractive to the highest income quintile will most likely experience stronger income growth and will most likely then better property price growth. Now, there's some things that I think, some tailwinds, I think that property in Australia is going to benefit from over the next couple of decades. And I'm going to talk about them in a second. But before I do, I wanted to talk about, is Australian property overvalued? Because over the last couple of decades, I've read several articles in The Economist magazine mostly. That's a common one. But, several articles comparing Australian property prices, making global comparisons, and sometimes those international comparisons, I mean, they might make for interesting fodder in terms of content for a magazine or a newspaper, and even, just discussion around the dinner table. But in terms of its application, in terms of drawing any particular conclusions, I'm not sure they're really meaningful. And there's a couple of reasons for that. Firstly, one of the challenges in Australia is the geographical concentration. So more than half the population, more than half Australia's population desires and lives in about 0.5% of the total land mass. So what I'm talking about there is Brisbane, Melbourne and Sydney occupy 0.5% of Australia's total land mass, but accommodate half the population. And couple that with something else. The other thing is we just don't have enough taxpayers per square kilometre. Our country's too big and we have too fewer taxpayers. So for example, we have about 2 taxpayers per square kilometre. That means that we can't build the level of infrastructure necessary to make living in regional areas as attractive as living in capital cities. For example, France has 60. We have 2. France has 60 taxpayers per square kilometre. That means whether you live in Paris or Lyon or in the south of France, wherever you might be, the amenity might not be exactly the same because they still have, country areas, of course, but there's very popular sort of satellite cities that will still have, good education, good job opportunities, schools, hospitals, all these sorts of things. And getting between different points in time, if you need to go into Paris, it's an easy commute on a very fast train. We can't do that in Australia. We can't make living in Newcastle, almost just as good as living in the eastern suburbs in Sydney. And because we can't build that infrastructure well enough, even though our population growth continues to grow, what happens is, particularly in Brisbane and Melbourne, is our cities start to really spread out. And we think, okay, well, we can just build more houses, but we're building them 40, 50 Ks away from the CBD. The problem is that we can build those houses, but the infrastructure isn't being built, certainly not cost effectively, but certainly not time effectively as well, or on a timely basis. And that's why suburbs that are, say, between 2 and 20 kilometres from the CBD offer the greatest amenity. And I think this will just become more stark because as the urban sprawl tends to, extend further and further away from the CBD, it'll just increase congestion, and it'll just mean like living 50 Ks away from the CBD is just going to be a real challenge in terms of getting into work and those sorts of things. I think then living in Hawthorn or living in Paran or living somewhere close to the city, Indooroopilly and Brisbane, it's going to be more attractive than being in those outer suburbs. The other thing too, we've got to think about the supply and demand, the scarcity element. We can't think about property as just one homogenous sort of asset class, if you like. We've got to think about the investment grade locations. A mentor told me that when he bought his property in the 70s in Sydney, in the southeastern suburbs, there were somewhere between 5,000 to 7,000 houses that fronted Sydney's harbour. Throughout the full harbour had some sort of water frontage, if you like. Back then, the population was 3 million people. Now, today, the population is 5.5 million, but there's still the same 5,000 to 7,000, houses, whatever that number is, that are facing. Now, that's scarcity, and that's what we're really thinking about here is what elements, what scarcity does this property have that makes it more and more desirable to those few that have a greater increase in purchasing power than the average Australian. And so property prices in investment grade locations tend to be somewhere between 1.5 to 3 times the median price for that broader city. And so I think anecdotally, that doesn't seem overvalued to me. Now, when we talk about is property overvalued and they look at, how many times average income you need to be able to afford a property, that's not to say that there's some property in some outer regions that doesn't have the same fundamentals as blue chip property, and maybe that's overcooked in terms of overvalued. So I think there's obviously, like in any market, like a stock market, there's always going to be some property that's overvalued, some that's undervalued. If we're looking at investment grade property, relative, the number of those properties relative to the population and the land area that those properties occupy and the reason reasons why those locations will become just more and more scarce and more desirable as the years unfold? No. I think paying 1 to 3 times the average doesn't seem overvalued to me. Okay, let's talk about capital inflows, because we know that when more money flows into any asset class, the prices of that asset class naturally increase, particularly if supply cannot match the increase in demand, which is certainly the case with property in the main. And I think that there's a couple of tailwinds that the property market will certainly enjoy over the next decade and probably beyond, that will see more money flow into the property market. And as a result, I think will stimulate price growth, not across the board, but in these investment grade locations. Firstly, falling interest rates. Now, I guess this is a bit of a shorter term observation, because interest rates are going to change over time. You can have periods where they're below average, above average, or average. It's not a big deal, but we know interest rates certainly do have a positive impact on prices, lower interest rates that is. And we're expected to get about 1% of cuts over the course of the next 12 months. I'm recording this podcast. Obviously, yesterday we had an RBA rate announcement. I don't know what that is because I'm recording it before that date, but excluding what happened there, we're expecting to get about 1% cuts. So from the peak, that's about a 1.5% total cut if that happens. And that's estimated to increase borrowing capacity by around about 15%, although there's, people are going to have different sensitivity to interest rates. But we know lower interest rates certainly stimulate demand. Okay, what about the $3 million super tax? So that's the tax that is on unrealized gains for anyone that has more than $3 million in super. Well, the Grattan Institute estimates around 80,000 Australians will be impacted by what's called Section 296 tax, and that's the unrealized gains tax, and 85% of these people are over 60. So clearly the easiest way to avoid paying tax on unrealized capital gains, which no one wants to pay, of course, is to either in specie transfer their asset out of super or sell the asset inside super and transfer the cash out. And you can do that. 85% of people can do that. So that's going to be an easy way to avoid that tax. The thing then is, where will that money go? Undoubtedly, some of that money will flow into the Australian property market. Now, which areas will that go into? Well, of course, it's going to go into those more blue chip locations, because they're the people that are familiar with, the people that have more than $3 million in super are probably very familiar with those locations and understand them and realize the benefits of investing in that location. So I actually think the 3 million super tax will actually have likely a positive impact on the Australian property market. Now, some of that money might already be invested in property and it might remain invested, but I think new monies will come into the property market. Also, we've got to think about future returns as well. When people divest of assets or move assets out of entities, then they think about, where am I going to put that capital? They really then consider, what will future returns be? And if we think about share market returns over the last few years, like the S&P 500's returned over 14% compounding for 13 years, that's a huge return, of course. That means you've made 5.5 times your money over that period of time. We know that periods, if there's a whole body of evidence, huge body of evidence that tells us that periods of above average returns are always followed by periods of below average returns. And if you look at all the evidence-based sort of models, peer review models that are out there, it shows that, or indicates, and there's about a 80% correlation here in terms of how effective or accurate these models are. But these models are showing that returns particularly out of the US market, will be probably less than half the long-term average. And if that plays out, people then start to look for asset classes that are more attractive. So if you put those two things together, I'm forced to take money out of super, and we're talking about millions of dollars here, forced to take money out of super, and we've just had great returns out of the US market, but we're really a bit concerned whether that's going to continue. Well, that's, I think, why more money will flow into property. The next thing is inheritance. Roughly about $10 billion is inherited per month in Australia, and it's really part of an estimated $3.5 trillion sort of wealth transfer. And in my experience, the clients that I've had that have inherited monies tend to use it very wisely. So they're not frivolous with it. They think very deeply about it. And, they almost treat that money with more caution than their own money. They want to do something smart with it. And I find they either upgrade their home or renovate their home, so put it into the property market, or invest it. And if they're investing it, some of it could go into property or shares, whatever it might be. The other thing that is very common is some of it gets passed on to grandchildren, potentially, adult grandchildren, that goes towards a housing deposit. So again, these inheritance money, these transfer of wealth, some of it is already invested in the property market, but arguably more of it will come into the property market also. And there is that strong sort of tailwind there. The next thing I'll talk about is employee share windfalls. So over the past decade, we've seen a notable increase of clients receiving substantial sums of money, sometimes life-changing sums of money, through employee share schemes. Now, that can be because of a sign-on bonus. It could be because of long or short-term incentive plans, discounted plans to buy stock. But, with globalization and more people, working from home and working for businesses and working for international businesses, particularly in technology, we've seen a lot of this. And it can substantially change someone's financial trajectory, either through improved borrowing power for investment, because it allows them to repay their home and then they've got more equity, or stronger purchasing capacity just because they've got a greater deposit or a greater sort of cash contribution. But these employee share windfalls are very important, and they're probably not really going to be captured too much in the data, I wouldn't have thought, when the ABS looks at household income and those sorts of things. But where are those people living? Typically in blue chip locations. And lastly, this is only going to add to a segment of the market, but obviously the federal government has removed the cap on the first home grant scheme, guarantee scheme, I should say. That's the scheme that allows people to buy a property with a first home buyer to buy a property with a 5% deposit, and the government will guarantee 15%, meaning they can avoid paying for lenders' mortgage insurance, and it'll help a lot more people into the market. Now, that's going to certainly stimulate from 1 January next year, certainly stimulate the sub $1 million price category or the sub $1.5 million price category in Sydney, because there's a different cap there. But that's going to obviously result in, again, more capital flowing into the property market. So not only is it just about rising incomes and the top 20% of income earners, the top quintile is earning 50% of the income in Australia, and they've got a growth rate that's 40% higher than the two quintiles below them. But they've also got sources of additional wealth over and above household income that allows them to spend more on property. So to achieve a 7% long-term growth rate, you've got to invest in a location that is attractive to people, to demographics, that are able to afford to pay 3 to 4 more times for that property in 30 years from now, over and above just the general 3% increase in household incomes. And so not all property is obviously going to benefit from that level of demand. It's just going to be particular locations. Now, I could be wrong, and there could be a lot of different policy and stimulus and all these sorts of things that occur over the next 3 decades, in which case, in a rising tide, all ships rise and everyone's happy. But the thing with investing is we've got to think about return and risk. So we've got to think about not only will all property give me 7%, but which property has the highest probability of delivering at least 7% over that period of time. Now, the follow-up question I got from the person that was watching on YouTube was, why would someone in the wealthiest 20% want to buy a 2-bedroom cottage on 200 square meters of land? I guess the thing is that there's going to be different categories of buyer. So my answer is there's going to be different categories of buyer for all different property types. So for example, in the top quintile in the 20s and 30s, they're not going to be able to necessarily afford a really large 4-bedroom family home in a blue chip suburb, right? That's out of their price point. But they want to get entry into the market. They don't want to compromise on the location. So for example, someone in their still high income earner, but in their 20s and 30s might be interested in a property like that. Now, of course, someone in their 50s isn't necessary, unless it's a pure investment, isn't necessarily going to be interested in an asset like that. So horses for courses. Of course, we just can't think that, if someone's super wealthy and they're not going to buy these smaller style properties. Even investment grade apartments, 2-bedroom apartments. Again, there's still going to be a cohort that's that's, in the higher income space. Also, it's really about the land, right? So it's not about we've got this 2-bedroom cottage that was built 100 years ago that, doesn't have the same amenity as like a brand new townhouse, for instance. But it's not really about the improvements, about 200 square meters of land in that quiet street, in that fantastic suburb. That's going to be the thing that's going to be the scarce asset. We can always improve the dwelling, and those dwellings naturally will be improved over the course of the next 3 decades. So my short answer is, can property grow at 7% perpetually for the next 30 years? I'll choose 30 years just as a rough marker, but, just generally, can property grow at 7%? The short answer is maybe. You have the highest probability of achieving this benchmark if the property is located in an area that appeals to the wealthiest 20% of Australians, either as a home or an investment, because not only do they have higher income growth, but they're most likely going to have access to other sources of wealth. Okay, let's get into some questions. And my first question is from John. John writes, could I get your thoughts on this scenario? If someone was planning to retire this year and had a super balance of 1.1 million and was planning to contribute 120 by 30 June and 360 early in the next financial year, so obviously, we're in July, so 320 this financial year, would it be a better option to open another super account and contribute the 480 into that accumulation account rather than mixing it with the 1.1? And the idea behind this would be quarantining after-tax contributions into one super fund. Because if they come out, if you pass away and your entire super balance is related to or has been because of after-tax contributions, like non-concessional contributions, as John is proposing to make, and then if they get left to a non-financial dependent, so an adult children, independent adult child, for example, which is common, there's no tax on that balance. Sometimes we've done this, right, where we've quarantined non-concessional contributions into a separate super fund. It's only going to work, well, it's mostly going to work if you did that. So, and what you did is you converted the existing super into pension phase, the 1.1, and you started drawing against that balance and you left the 480 in accumulation. That would work effectively because essentially what you're doing is you're using what would be a taxable inheritance first and then using the non-taxable inheritance last. But by doing that, you're still going to pay 15% tax on the income and capital gains, well, 10% tax on the capital gains for that period. So you will pay a little bit more income tax. Whereas if you mixed it into one account, you're still going to potentially get the same outcomes from a inheritance perspective because it's proportional, the amount of the account that's from taxable versus untaxable. But obviously you've got to draw proportionately against those two elements. So look, would I do it in that scenario? I guess it just depends on how long you think you're going to live for and how much of the super balance is going to be left. The other thing too is if you withdraw all your super before you die, there's no tax on that. And then it's just cash savings. So there's not going to be any tax to your beneficiaries as well. So I would think that the tax saving on the investment returns, if you're, healthy and you expect to live for the next 20 years, are probably going to be worth more to you than the potential inheritance saving down the track because, you're eating away proportionately. If you die in the next 5 years, it's not going to be a big deal. But if you mix it and you die in, say, 15 years, okay, yeah, it's probably more tax effective the other way around. But I don't think I'd get that excited about it. And I would just be of a mind. And we don't always know when we're going to die, of course. Some things happen unexpectedly. But, if you started to experience ill health and you thought you were pretty close to, the end of your life, that's when you withdraw all your super. And therefore, the beneficiaries, if they're non-financially dependent, they're not going to pay any tax. Okay, next question is also from John, but it may be a different John. And he's asking about the new Div 296 tax, which is the tax on balances, super balances in excess of $3 million. And the tax applies, extra 15% tax rate applies on unrealized capital gains. And he's asked the question about whether putting those investments or putting all your investments, in fact, in a company, an unlisted company, and just a private company, that the super fund owns the shares of that company, whether you could play with the market value of the shares in that company, just like listed investment companies. So there's two types of kind of listed investments for those people that are not aware. ETFs, which I talk about, exchange traded funds, they tend to be low cost index style investments. I talk a lot about them. I really like them. There's those assets. And then there's listed investment companies, which I don't talk a lot about because they tend to be actively managed rather than passively managed. And there's a large body of evidence that shows that active rarely beats passive over long periods of time, and they attract higher fees, right? So they're LICs, listed investment companies. The share price for listed investment companies can trade at a discount or premium to net tangible assets. So if these companies hold all these stocks and whatever, they might be worth $100, but the value of that company, the market cap, might be worth $80, and it might be trading at a discount. And they often do trade at a discount, maybe just because we disbelieve that the active manager can produce good returns, or there might be liquidity issues or whatever. And so what John's saying is, can't we use the same argument to get around the 3 mil super cap? Put all our investments in our own LIC, if you like, and value it at a discount to net tangible assets. Well, the answer is in the definition of market value. So that market value is what an asset will trade for in an open and transparent sales process between a buyer and seller that is informed and not under any compulsion to either buy or sell. Right, that's the definition of market value. So if I've got an LIC and it's trading at a certain share price, and if that share price happens to be a discount or premium to net tangible assets, who cares? That's the market value because it's been traded in an open, transparent manner. However, if you have your own unlisted LIC, there's no trading, right? We've got to go to a theoretical valuation. And in that situation where it's a non-trading company, you would just go with net assets. And the net assets are going to be easy of that company to derive because it's investing in a whole bunch of listed assets. That is the value. It's going to be impossible to argue that the value of the shares in that company are less than the net tangible assets, particularly if you don't have any evidence to demonstrate that like you do with LICs. Anyway, John, good question, good thinking in terms of are there ways to sort of avoid this tax? I think I might end up doing an episode on 293 if and when it becomes law, which I'm obviously expecting it will. But I think the easiest answer is just take the money out of super, put it in a family trust with a corporate beneficiary, and you're going to avoid the tax on unrealized capital gains. So there's not going to be any revenue raised, additional tax revenue that the Labor government might suggest. I think they're predicting something like $2.3 billion, no chance. And that's going to be an easy way to get around it. Okay, gone over time again today. Apologies for that. Until next week. Bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.